What if I told you that silver is about to do something it hasn't done in over 40 years? And what if the people who see it coming are the same institutions that called the last three major commodity bull markets? Would you pay attention then? Because right now, while everyone's distracted by the noise in equity markets, something extraordinary is happening in the silver market. And I'm not talking about some technical pattern on a chart or a hopeful prediction from a permabull. I'm talking about fundamental shifts in supply, demand, and market structure that only happen once in a generation. Let me show you what's really going on. The silver market is roughly 17 times smaller than gold. Total annual silver production is around 830 million ounces. Sounds like a lot, right? But here's where it gets interesting. Industrial demand alone consumes about 560 million ounces of that. Solar panels, electronics, electric vehicles, 5G infrastructure, medical applications. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technology that's supposed to save us from climate change. And that industrial demand, it's accelerating. The Silver Institute projects that solar panel production will consume 185 million ounces by 2025. That's up from 110 million ounces just 3 years ago. Electric vehicles use twice as much silver as traditional cars. Every charging station, every solar farm, every data center requires silver. And we're building them by the thousands. But here's the problem. Silver production peaked in 2016 at 900 million ounces. Since then, it's been declining. Not because we don't want to mine more silver, because the easy deposits are gone. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices drop, silver production drops with it. And right now, we're facing a structural deficit of about 150 million ounces per year. Let me put that in perspective. That deficit equals roughly 18% of total annual production. Imagine if 18% of global oil production just disappeared. What would happen to oil prices? They'd explode. But silver? It's been trading in a relatively narrow range for years. Why? Because the paper market has been suppressing the price through massive short positions on the COMEX. And that's where this story gets really interesting. In September 2020, JP Morgan paid a $920 million fine for manipulating precious metals markets. Not alleged manipulation, proven manipulation. The Department of Justice called it a massive multi-year scheme to manipulate the market for precious metals, futures contracts. Traders at JP Morgan were literally spoofing the market, placing fake orders to move prices, then canceling them before execution. They did this thousands of times over 8 years. But here's what nobody talks about. While JP Morgan was suppressing silver prices through paper manipulation, they were simultaneously accumulating the largest physical silver position in history. Their vault in New York holds over 150 million ounces of physical silver. That's nearly 20% of annual global production sitting in one vault. Think about that for a second. They paid $1 billion fine for manipulating prices down while they were buying physical metal. Does that sound like the behavior of an institution that thinks silver is going lower? Now, fast forward to today. The COMEX silver inventories have dropped from 400 million ounces in 2021 to under 280 million ounces today. That's a 30% decline in available physical silver in the exchange warehouses. Meanwhile, open interest in silver futures has exploded. There are now paper claims on roughly 900 million ounces of silver, but only 280 million ounces of physical metal backing those claims. That's a ratio of more than 3 to 1. 3 paper claims for every ounce of physical silver, and it's getting worse every month. You know what happened the last time we saw this kind of setup? 1980. Silver went from $6 to $50 in less than a year. The Hunt brothers tried to corner the physical market, and the paper shorts got absolutely destroyed. The COMEX had to change the rules mid-game to prevent a complete meltdown of the futures market. They literally made it illegal to buy silver futures, only allowing liquidation orders. But this time is different. This time, it's not 2 billionaire brothers trying to corner the market. It's industrial demand that cannot be stopped. You can't change the rules to make solar panels use less silver. You can't regulate away the silver needed in electric vehicles. The demand is real, it's growing, and it's not going away. And the supply situation is getting worse, not better. Primary silver mines are becoming increasingly rare. Most new silver production comes from polymetallic deposits, where silver is a secondary product. When copper prices crashed in 2023, several major mines reduced production. That silver didn't come to market, and it's not coming back quickly. Mexico, the world's largest silver producer, has been tightening regulations on mining. Peru, the second largest producer, is dealing with social unrest that's disrupting operations. These aren't temporary problems. These are structural issues that will constrain supply for years. Meanwhile, central banks around the world are quietly accumulating silver alongside gold. The People's Bank of China has been buying silver through state-owned enterprises. Russia has been stockpiling silver as part of its de-dollarization strategy. Even smaller nations are starting to see silver as a strategic resource, not just a monetary metal. And then there's the retail investor demand. In 2023, retail investors bought over 300 million ounces of silver in the form of coins and bars. That's more than the entire annual production of primary silver mines. The U.S. Mint sold out of Silver Eagles multiple times. Premiums on physical silver spiked to $8 over spot. People were paying 30% premiums just to get their hands on physical metal. But here's what really tells you something big is coming: the gold to silver ratio. Historically, this ratio averages around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, that ratio is sitting at 88 to 1. Silver is historically cheap relative to gold. Every time this ratio has gotten this stretched, silver has violently snapped back. In 2011, when the ratio hit 85, silver rallied from $18 to $48 in 6 months. In 2020, when the ratio briefly touched 125, silver doubled from $12 to $28 in 4 months. The ratio doesn't stay this high for long, and when it corrects, silver moves fast. Now, I want to take a quick detour here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how precious metals fit into a retirement strategy. I put together a comprehensive guide on gold and silver IRAs. It's completely free, link is in the description. It covers how to get physical metals into your retirement account without triggering tax penalties, which custodians are reputable, and how the whole process works. If you're thinking about protecting your retirement savings with precious metals, it's worth checking out. No obligation, just information. All right, back to why silver is setting up for this massive move. The technical picture is confirming what the fundamentals are screaming. Silver has been consolidating in a tight range between $22 and $26 for over 2 years. That's a textbook accumulation pattern. Big money doesn't buy all at once. They accumulate slowly, quietly, over months and years. And that's exactly what this price action shows. The 200-week moving average is starting to turn up. The weekly MACD is showing bullish divergence. The monthly chart is forming a massive cup and handle pattern with a measured move target above $60. These aren't hopium technical patterns. These are the same setups that preceded every major silver rally in history. But the real catalyst is going to be the short squeeze. There are currently over 200 million ounces of short positions on the COMEX. That's nearly a full year of primary silver mine production. And those shorts are held by a handful of large commercial banks. When silver starts moving, those shorts are going to scramble to cover, and there's not enough physical silver available to cover those positions. You know what happens when everyone tries to exit through the same door at the same time? Panic. Prices gap up. Liquidity disappears. And the people who waited to buy physical silver find out that there isn't any available at any price. We're already seeing early signs of this. Spreads between paper silver and physical silver have been widening. In some markets, physical silver is trading at a 15% premium to the paper price. That's not normal. That's a sign that the paper market is losing credibility. People want the real thing, not a promise on a screen. And here's something most people don't know. The LBMA, the London Bullion Market Association, has been quietly draining silver. Their vaults held over 1.1 billion ounces in 2021. Today, they're down to under 900 million ounces. That's 200 million ounces that left the vaults in less than 3 years. Where did it go? Into strong hands, into industrial applications, into private vaults where it's not coming back to market. This is exactly what happened before the 2011 silver rally. COMEX inventories dropped. LBMA inventories dropped. And then silver went from $18 to $48 in 6 months. The setup today is even more extreme because industrial demand is higher and supply is tighter. Let me tell you a story that perfectly illustrates what's happening. In 2008, there was a small Canadian company called Silver Wheaton, now called Wheaton Precious Metals. They had a simple business model. They would pay upfront capital to mining companies in exchange for the right to buy their silver production at a fixed low price. Streaming deals, they called them. In early 2008, silver was trading around $15. Silver Wheaton's stock was at $4. Then the financial crisis hit. Silver dropped to $9. Silver wheaton dropped to $2. Everyone thought precious metals were dead. But a few smart investors saw what was really happening. Central banks were printing money like never before. Industrial demand for silver was about to explode as the world rebuilt. And silver wheaton had locked in decades of silver production at $4 per ounce. By 2011, silver hit $48. Silver wheaton stock hit $43. That's a 21x return in 3 years. The people who bought when everyone else was panicking made generational wealth. We're in a similar moment right now. Everyone's focused on AI stocks and tech. Nobody's paying attention to silver, but the smart money is accumulating. The fundamentals are screaming, and the technical setup is nearly identical to 2008. Here's another thing to consider. The energy transition requires massive amounts of silver. Every solar panel uses about 20 grams of silver. Doesn't sound like much, right? But when you're installing 200 gigawatts of solar capacity per year, that adds up to 185 million ounces. And solar installations are accelerating, not slowing down. Electric vehicles use about 25 to 50 grams of silver per vehicle, depending on the model. Global EV sales are projected to hit 30 million units by 2030. That's another 30 to 60 million ounces of annual demand that didn't exist 5 years ago. 5G infrastructure requires silver for its superior conductivity. Every 5G base station uses silver. Every smartphone uses silver. Every data center uses silver. The digital economy runs on silver, and we're building more digital infrastructure than ever before. But here's the kicker. Unlike other commodities, silver doesn't get recycled efficiently. When you use copper in wiring, you can melt it down and reuse it. When you use silver in solar panels, it's gone. It's dispersed in such small quantities across millions of panels that it's not economically viable to recover. That silver is effectively removed from the supply forever, so we have declining mine production, accelerating industrial demand, and inefficient recycling. That's a recipe for a supply crisis. And supply crises in small markets create explosive price moves. Now, let's talk about what the big institutions are doing, because they're not sitting idle. BlackRock launched a silver ETF that's accumulated over 500 million ounces. That's more silver than most countries produce in a year. Sprott Physical Silver Trust holds another 200 million ounces. These aren't paper claims. These are physical ounces sitting in vaults, removed from the market. And it's not just ETFs. Billionaire investors are buying silver mining companies. Eric Sprott has invested hundreds of millions into silver miners. Rick Rule, one of the most successful resource investors in history, has said publicly that silver is the most undervalued asset he's seen in his 50-year career. When legends like Rick Rule, who's made billions in resource investing, say something is undervalued, you pay attention. These aren't promoters. These are people with track records spanning decades. They've seen every commodity cycle. They know what extreme undervaluation looks like. And they're putting their money where their mouth is. The geopolitical situation is also setting up perfectly for silver. As tensions between the US and China escalate, both sides are stockpiling strategic resources. Silver is on that list. It's critical for military applications, from missiles to electronics to communication systems. Countries don't want to be dependent on adversaries for critical materials. The BRICS nations are working on a commodity-backed currency to challenge the dollar. While gold gets most of the attention, silver is part of that conversation. Russia and China have been accumulating silver reserves. They understand that in a multipolar world, hard assets matter. And then there's the inflation picture. Real inflation, not the manipulated CPI numbers, is running hot. Food prices are up, energy prices are up, housing costs are up. People are looking for ways to preserve purchasing power. Silver has been money for 5,000 years. It's not going away. But unlike gold, which has already rallied significantly, silver has barely moved. It's still 50% below its 1980 high when adjusted for inflation. Think about that. Silver would need to hit $140 just to match its inflation-adjusted 1980 peak. Gold has already exceeded its inflation-adjusted 1980 high. Silver hasn't even come close. That's not because silver is less valuable. It's because the paper market has been suppressing the price while physical demand has been quietly absorbing all available supply. But that can't continue forever. Eventually, the paper market breaks. And when it does, the price discovery will be violent. We're seeing early signs of that break happening now. Basis spreads are widening. Delivery failures are increasing. Premiums on physical silver are rising. These are all symptoms of a market under stress, a market where paper promises are starting to lose credibility. And here's something that should terrify the shorts. Retail investors are getting educated. The Reddit silver squeeze in 2021 was just a preview. Millions of people learned about the paper manipulation. They learned about the disconnect between paper and physical. They learned that they can force delivery and drain the COMEX. That movement didn't go away. It went underground. People are still buying physical silver every month. They're still taking delivery. They're still removing ounces from the system. It's a slow squeeze, but it's relentless. And eventually, the shorts will have no choice but to cover. When that happens, we're going to see price moves that seem impossible. Silver could gap up $5 in a single day. It could rally 50% in a month. It could double in a quarter. That's not hyperbole. That's what happens in small markets when supply disappears and everyone wants in at the same time. The 2011 rally saw silver go from $18 to $48 in 6 months. That's a 167% gain. But the real money was made in silver mining stocks. Some junior miners went up 10 times, 20 times, even 50 times. Because when silver moves, the leverage in mining stocks is extraordinary. A silver miner producing at $15 per ounce makes $10 profit when silver is at $25. But if silver goes to $50, they're making $35 profit. That's a 250% increase in profit margins. And stock prices follow profit margins. That's why mining stocks can go up 10 times when the metal doubles. But you have to be positioned before the move. Once silver starts running, the mining stocks gap up. You can't get in at reasonable prices. The opportunity is now, while everyone's ignoring silver. While the smart money is accumulating. While the fundamentals are screaming and the technicals are setting up. History doesn't repeat, but it rhymes. And right now, silver is rhyming with every major bottom in the last 50 years. The accumulation pattern, the supply deficit, the industrial demand surge, the paper market manipulation, the institutional accumulation. It's all there. The question isn't if silver is going to move. The question is when. And more importantly, will you be positioned when it does? Because here's the thing about these generational moves. They don't wait for everyone to be ready. They don't announce themselves with headlines and CNBC coverage. By the time the mainstream media is talking about it, the move is already halfway done. The real money is made by the people who see it coming and position early. Right now you have that opportunity. Silver is still cheap. Physical metal is still available, though premiums are rising. Mining stocks are still trading at valuations that won't last once silver starts moving. The setup is there. The catalysts are aligning. The smart money is positioned. The only question is, will you be ready when silver makes its move? Because when it does, it's going to be the biggest opportunity in precious metals we've seen in over a decade. And opportunities like this don't come around often.